Good morning, and welcome back to Talk Tickers.
Morning, everyone.
It is Wednesday morning, February 25th, 2026. And if you're staring at your trading terminals right now or, scrolling through your brokerage app on your commute,
You are probably seeing a lot of red.
you are seeing a sea of red next to a ticker that, by all logical accounts, should be green today.
It could be bright green.
Right. So we're here to cut through that noise. That's the whole point of this deep dive. We are here to find the actual signal in the earnings that move the needle for serious market watchers.
That is the mission. And today, we have a case study on the desk that is practically designed for a business school debate.
Oh, absolutely.
It's got everything. It's got massive growth. It's got shrinking profits, a huge pivot to luxury, and this really high-stakes gamble on high fashion.
Yeah, we are talking about Amer Sports. Ticker symbol is AS. Now, they dropped their Q4 and full year 2025 earnings yesterday afternoon, so February 24th. And honestly, reading through this report, it's like a Rorschach test.
It really is. It depends entirely on what kind of investor you are.
Exactly. You look at the top line and you see this absolute growth monster. But then you look at the bottom line and you see a company that looks like they're just burning cash to buy coolness.
Right. It's that classic conflict. It's the tension between immediate gratification, hitting that quarterly profit margin that analysts want, and long-term empire building.
Yeah.
It's the difference between selling a ski today versus building a lifestyle legacy for the next 10 years. And the market voted with its wallet this morning.
It did. Let's set the scene properly for you. It's the morning after the print is out. And looking at the tape right now, Amer Sports shares have taken a legitimate hit.
Yeah, they have.
They are down approximately 5.58%, trading right around $38.23.
Which, on the surface, it feels like a punishment, right?
It does.
A 5% haircut is significant for a company that just reported the numbers we're about to discuss.
And that's the hook. That is why we are dedicating this entire deep dive to this one company today. Because this company grew revenue by 28% year over year.
Massive.
They beat the consensus revenue estimates. They beat on earnings per share. And yet the market sold it off.
Because in this specific market environment, and we've been seeing this trend building throughout late 2025 and now into early 2026, investors are asking a very specific, very painful question.
Which is?
How much did it cost you to get that growth?
The cost of cool. That is exactly what we're calling this session. Amer Sports isn't just a holding company for, skis and tennis rackets anymore. They are making this massive, aggressive, and incredibly expensive bet on becoming a global fashion powerhouse.
And the bill for that bet just came due in the operating margins.
It sure did.
And that is exactly where the tension lies today. So let's unpack the actual numbers before we get into the strategy, because honestly, the top line performance was genuinely an outlier.
It was a monster quarter for sales. So let's look at the quote unquote beat. Revenue came in at $2.101 billion.
$2.1 billion.
Right. And the consensus on the street, what the smart money was expecting, was sitting around $1.99 billion. So they cleared that $2 billion mark for the quarter very comfortably. That's a 28% jump year over year.
Let's just pause and contextualize that $2.1 billion figure for a second. We are operating in a macro environment where consumer discretionary spending is supposedly soft.
Right. Everyone's talking about the pullback.
Exactly. We keep hearing about the stretched consumer. We hear about credit card debt, luxury fatigue, all of it.
Mm-hmm.
And here comes a company selling $800 jackets and high-end trail runners, and they're putting up 28% growth.
That's wild.
That isn't just good.
Yeah.
That is breakout territory. They're actively stealing market share from someone else.
And they didn't just sell more stuff. They actually made money on it, technically. Adjusted earnings per share came in at 31 cents.
Versus the 28 cents expected.
Right. So a 3-cent beat on the bottom line there. JAP net income was $132 million. So if you're just reading the headlines on your terminal, you're thinking, great quarter, stock goes up.
But you have to turn the page.
Yep.
You have to look at the quality of those earnings. And when you get to the profitability ratio, specifically the operating margin, all the air just goes right out of the room.
The ouch number.
The ouch number, precisely. Adjusted operating margin fell to 12.5%. That is down 110 basis points from last year.
Wow.
Now, for you listening who maybe don't speak basis points fluently, 100 basis points is exactly 1%. So their profit margin dropped by 1.1%.
Which, I mean, it doesn't sound like a lot to the layman.
It sounds like a rounding error.
Yeah.
But in a business doing $2 billion in revenue, losing over a full percent of margin when your sales are skyrocketing, that's alarming. It completely defies the concept of operating leverage.
Okay, define operating leverage for us really quickly, because this is the absolute core of the bear case today.
Sure. So operating leverage is this idea that you're fixed, cost your rent, your electricity, your corporate salaries, all of that, those stay relatively flat while your sales grow.
Because you don't need two headquarters just because you sold twice as many jackets.
Exactly. So every extra dollar of sales should be more profitable than the last one. Your margins should inherently go up as you get bigger. Amer Sports got bigger, much, much bigger, but their margins went down.
So they are becoming less efficient as they scale.
Not necessarily less efficient, but much more expensive to run. And we know exactly why, because management didn't hide from this on the call at all. They explicitly said this margin pressure was entirely due to accelerated SG&A investment.
SG&A, selling, general, and administrative expenses.
The corporate credit card.
Right.
Marketing, salaries, fancy offices, store leases. And they pointed the finger at one brand in particular. It wasn't Arcteryx, it wasn't Wilson, it was Salomon.
And this is the crux of our discussion today. We have a portfolio here. You have Arcteryx, which is the golden child, the bank. You have Wilson, the steady veteran. And then you have Salomon.
Salomon is currently the rebellious teenager taking the family credit card to Paris to reinvent themselves.
I love that.
Well, I wouldn't even call them a teenager, really. I'd call them a venture capital startup that's trapped inside a publicly traded company. But the analogy holds.
Yeah.
We are going to dig into exactly what Salomon is spending that money on, because it is fascinating. But first, I do want to highlight one bright spot in the margins before we get too negative.
Because it does complicate the bear case.
It does. Gross margin was actually up significantly.
It was. Gross margin hit 57.8%. That's up 140 basis points.
That is a very, very strong signal. Gross margin is what you make on the product itself. It's the difference between what it costs the factory to sew the jacket and what you sell it to the customer for. The fact that this metric is up tells us two very important things. One, their supply chain is healthy. Right. They aren't getting crushed on raw materials. Two, and more importantly, they have immense pricing power.
They aren't discounting.
Exactly. They aren't putting everything on clearance to move this $2 billion of product. The brand heat is real. People are paying full price. The problem is purely on the corporate spending side.
Okay, so let's get into the segments. Because Amer Sports is really just a holding company wrapper. The real story is the tale of three cities underneath the hood.
Yep.
You have the technical apparel segment, which is mostly Arcteryx. You have outdoor performance, which is Salomon. And you have ball and racket, which is Wilson. Let's start with the crown jewel, Arcteryx.
The engine of the entire ship.
Truly. If you ever needed proof that selling technical raincoats is a better business than selling almost anything else on the planet, this is it. Revenue for this segment was up 34% to hit $1.0 billion.
$1 billion quarter just for the apparel segment alone.
Just massive.
That is a huge psychological threshold to cross. And unlike the broader group, the margins here were just beautiful. Segment operating margin actually expanded by 160 basis points to 25.9%.
Nearly 26% operating margin. That is luxury territory.
Completely.
That is approaching the likes of a Moncler or even an Hermes.
It is, and it's functioning as the central bank for the rest of the portfolio. The massive profits pouring out of Arcteryx are essentially funding all the wild experiments happening over at Salomon.
Yeah.
And the drivers of this growth for Arcteryx are really interesting, because it shows the brand is evolving way beyond just hardcore climbing gear for men.
Totally. I was looking at the breakdown in the report, and they highlighted the women's category specifically. It grew over 40%. They called out specific products, too, like the Endesa down jacket and the Coel parka.
I've actually seen the Coel in person. It's a fascinating product because it is technically capable. I mean, you could wear it in a blizzard and be totally fine.
Right.
But the silhouette, the cut, the matte finish, it's designed for Fifth Avenue. It's designed for the winter commute in London or New York.
It's not for the base camp, it's for the boardroom.
Exactly. And that transition from pure utility to lifestyle luxury is the absolute key to that 26% margin.
Because the market is bigger.
Way bigger. When you can sell an $800 parka, not just to someone climbing Everest, which let's face it, is a tiny, tiny market.
Very small demographic.
Right. But when you can sell it to someone who just wants to stay warm walking to get an iced coffee in Soho, your addressable market literally explodes.
Speaking of Soho, their retail strategy is just on fire right now. They mentioned the new Alpha store in Rockefeller Center in New York.
Oh, yeah.
And they opened mountain stores in Aspen and Park City. These aren't just, gear shops. They are temples to the brand.
They are immersive showrooms.
Yeah.
And notice the shift in the real estate strategy, Rockefeller Center. That is not a trailhead location.
Not at all.
That is mainstream, high traffic, global tourism luxury.
Mm-hmm.
It signals exactly who they think their core customer is now. It's the international tourist who might walk into a boutique and buy a Louis Vuitton bag, or they might walk next door and buy an Arcteryx shell.
And footwear. We have to talk about Arcteryx footwear. It was up nearly 40%.
Incredible growth there.
They mentioned the Northern Trail shoe and the Crag Approach shoe. I feel like, 5 years ago, absolutely nobody wore Arcteryx shoes. They just bought the jackets. Now I see these shoes everywhere.
It's the logical extension of the uniform, really. Once you own the jacket, you kind of want the pants.
Yeah.
Once you have the pants, you want the shoes to match. It's about capturing the full share of the consumer's wallet from head to toe.
Yeah.
And because they are pushing this primarily through their direct-to-consumer channel, which, by the way, DTC grew 38% globally for the group.
38%.
Right, because they sell direct, they keep all that margin. They aren't sharing the profit with a middleman retailer like an REI or Dick's Sporting Goods to nearly the same extent they used to.
That makes total sense. Now, one little detail I loved from the call, and I want to get your take on this, was the Rebird program.
Oh, this is fascinating.
This is their trade and sustainability initiative. They actually increase the trade-in credit to 30% of the original value of the item. And management said this drove a, quote, notable jump in activity. Is this just corporate greenwashing, or is there a real business case here?
Oh, the business case is brilliant. It's absolutely brilliant. It does two major things for them. One, it reinforces the narrative that these products are durable assets that hold value. You aren't just throwing an old coat away.
You're trading it in.
Right. You're trading it in like a luxury car. It elevates the prestige of the item. But two, and this is the absolute genius part of the retail strategy, it gets the customer physically back into the store. You hand in your old jacket, you get a credit. But that 30% credit is never enough to buy a brand new jacket outright.
Of course not. You still have to pay the difference.
Exactly. So you have to spend new money to use your credit.
Yeah.
It is a highly effective loyalty loop, perfectly disguised as sustainability.
Wow. Okay, so Arcteryx is the straight-A student, does everything right, brings home the big margins. Now let's talk about the problem child, or maybe the next star, depending on how charitable you want to be this morning. Salomon.
The outdoor performance segment.
This is where the controversy lies. This is exactly why the stock is down 5.5% today.
It is the whole story for the bears.
So let's look at the growth first, because the top line was great. Revenue was up 29% to $764 million. Salomon officially crossed $2 billion in annual sales for the first time in its 79-year history.
Which is a massive milestone. A 79-year-old ski binding company from the Alps doing $2 billion in sales is objectively impressive.
It is.
But the cost of crossing that milestone was steep. Really steep. Segment operating margin completely collapsed. It fell 490 basis points.
Nearly 5% drop.
Down to just 6.2%.
That is a staggering drop. A 6.2% margin for a brand with that much cultural heat right now. You have to ask, where did all the money go?
Well, management essentially gave us a line item receipt on the earnings call. They are pivoting Salomon from a traditional hiking boot brand into a high-end sports-style sneaker brand. And that pivot is incredibly capital intensive.
Let's list the expenses, because reading through it, it really reads like a corporate shopping spree. First, the Paris hub. They opened this massive new design and showroom office right in Paris.
Which is strategic, definitely, but very expensive. Look at their history. Salomon is traditionally based in Andalusia, down in the French Alps.
Right near the mountain.
Beautiful place. It's a fantastic place to test skis and trail running shoes, but it is a terrible place to recruit high-fashion sneaker designers. If you want to compete with Balenciaga, with Nike, with Adidas in the streetwear space, you need to be in Paris. You have to be where the cultural talent is.
And speaking of that talent, they hired a new creative director, Heike Salonen. I actually looked up his resume before we started recording. It isn't the North Face. It isn't Patagonia. He comes from Diesel and MM6 Maison Margiela.
And that tells you everything you need to know about the strategy right there.
Yeah.
They aren't hiring a guy whose primary obsession is Gore-Tex and waterproofing. They are hiring a guy who knows runway shows, high-end materials, and fashion silhouettes.
Right.
They are explicitly targeting the luxury fashion consumer, not the hiker.
Then there was the marketing spend. They sponsored the Milano Cortina Winter Olympics.
Huge undertaking.
They outfitted 27,000 volunteers.
That creates incredible ubiquity for the brand. Seeing that says logo on 27,000 people walking around a global televised event is powerful. But it costs an absolute fortune. That is a massive check to write.
And finally, the retail expansion. This one blew my mind. They opened 25 net new stores in China in the fourth quarter alone.
Yeah.
That is almost a new store opening every 3 days for 3 months straight.
That is what you call a land grab. They are seeing the momentum in China, where Salomon grew by massive double digits, and they are looking at that and saying, we need to capture this demand right now, today.
But the market hates it.
The market hates it because it completely kills the profit margin for the current quarter. Renting and building out 25 storefronts in prime Chinese real estate over 90 days is not cheap.
So the bear case is essentially that they are burning margin today to artificially buy market share for tomorrow. They are trying to take this 79-year-old ski brand and force it to be cool for 20-year-olds in Shanghai and New York.
Correct. And to be fair to management, the data suggests it's actually working on the top line. The sports style categories, it's the fashion sneakers like the XT6 and the new XT Whisper model. Those are flying off the shelves.
Right.
But investors looking at this specific quarter are saying, okay, great, you sold a ton more shoes, but you spent all the profit from those shoes on fancy offices in Paris and Chinese real estate. When do we get paid?
When do we get paid? That is the eternal Wall Street question. And it seems like for Salomon, the answer right now is just not yet.
Not yet. And that requires patience, which, as you know, is a very rare commodity on Wall Street.
Very rare.
Management is betting that once these stores are open and the brand is firmly established as a fashion staple, the marketing spend will level off. They'll pull back on the ad budget and the profits will just pour in.
But that's a risky bet.
Incredibly risky, because fashion is notoriously fickle. What if the trend shifts next year?
Right. What if Gorpcore dies? What if everyone stops wearing outdoor gear in the city and goes back to wearing, I don't know, leather loafers?
Exactly. Then you're holding the bag on a lot of expensive multi-year leases and a massive Paris design office for a brand that the cool kids have moved on from. That is the exact risk premium that is currently weighing down the stock price today.
Okay, let's move to the third sibling in the Oppen portfolio, the reliable one, Ball and Racquet, Wilson.
A nice return to form here.
Yeah, revenue was up 14% to $337 million. This was actually a relief to see because Wilson had been pretty sluggish for a while. They were dealing with some major inventory bloat over the last year.
They had been, but the story here, structurally, is very similar to Arcteryx and Salomon. It's a massive pivot to apparel. They call it soft goods. Wilson soft goods doubled in 2025. It is now 15% of the total segment.
So they aren't just selling you the tennis balls and the rackets anymore. They're selling the outfit you wear to the country club.
And the high-end hoodie you throw on after the match, it's the lifestyle play again. And look at leaderships. They just hired a new CEO for Wilson, Carrie Ask. She officially starts on March 1st. And look at her background. Ex-Levi's, ex-Nike.
Again, not a manufacturing expert who knows how to string a racket, a brand and apparel expert.
Precisely. The pattern across the entire Amer Sports portfolio is completely identical. You take a heritage performance brand, you wrap it in high-margin lifestyle apparel, and you sell it directly to the consumer. Whether it's skis, tennis, or hiking, the playbook is exactly the same.
And even in the legacy equipment side, they did have a hit. The Louisville Slugger Super Bat drove a solid return to growth in the baseball division.
Which is really important to have. You need the hard goods, the bats, the balls, the rackets to provide a steady, reliable cash flow floor while you chase the higher risk apparel upside.
All right, so that's the segments. Now I want to zoom out and look at the geography. Because if you want to understand why Amer usually trades at a premium multiple compared to its peers, it's almost entirely because of China.
The China engine is absolutely roaring right now. Greater China revenue was up 42%, and Asia Pacific, excluding China, was up 53%.
That is astronomical growth for a physical product company. What is driving that over there?
It is pure brand heat. In China, Arcteryx has become a status symbol on par with a Louis Vuitton or a Gucci bag.
Really?
Yes. There was actually a viral trend on social media over there a while back about guys wearing their Arcteryx jackets in the shower just to film the water beating off the Gore-Tex to show off the waterproofing. It literally became a cultural flex.
That is ridiculous.
It's totally ridiculous, but it's incredibly profitable. Oker has positioned these brands in Asia as ultra premium. They didn't go in trying to be a cheap alternative, and now Salomon is drafting right behind Arcteryx, becoming the cool shoe for that exact same younger, wealthy demographic.
They also mentioned the Americas grew 18%, which they noted was actually an acceleration, especially in the direct-to-consumer channels here in North America. But I really want to touch on the elephant in the room that came up during the Q&A portion of the call. Tariffs.
Right. There was a lot of chatter from analysts about the 15% tariff discussions and those recent Supreme Court rulings regarding trade.
When management seemed, honestly, remarkably chill about it.
They were very dismissive. I think the exact phrase was they expect an immaterial impact.
How can a massive global importer say a 15% blanket tariff is immaterial?
Two main reasons. First, their actual exposure to the U.S. is relatively low compared to their total global footprint. They're huge in Europe and, as we just said, massive in China. So U.S. tariffs only hit a specific portion of their total book of business.
Okay, fair.
But the second, and much more important reason, goes back to what we discussed earlier, pricing power.
Explain how that deflects a tariff.
Think about it. When you sell a jacket for $800, your margins are inherently fat. Remember that 58% gross margin number. If a new tariff hits, you have two choices. You can absorb it yourself, which Amer can afford to do because the margin is so wide, or you pass it on to the consumer.
Right.
If that $800 jacket suddenly becomes an $850 jacket to offset the tariff, does the Arcteryx customer walk away?
Probably not. If you're dropping $800 on a raincoat, you're probably entirely fine spending $850.
Exactly. They are not selling commodities. If they were selling basic white cotton t-shirts, a 15% tariff completely destroys their business model. But in the luxury and premium space, the consumer is largely price inelastic. They are essentially tariff resistant.
One other thing that stood out on the balance sheet inventory was up 33%. Now that is faster than their sales growth. Usually when you look at retail, if inventory outpaces sales, that's a massive red flag. It means you're stuck with stuff in the warehouse you can't sell.
Usually, yes, that's a panic moment. But management defended it pretty well with a logistical argument. They said it's a strategic shift. They are deliberately using much more ocean freight right now instead of air freight.
Because boats are cheaper than planes?
Much, much cheaper, but obviously much slower. So these goods spend weeks, sometimes months, just sitting on a container ship crossing the ocean. While they're on that ship, accounting rules dictate they are counted as inventory on Amer's books. So the headline number looks bloated, but a huge chunk of it is actually just goods in transit.
Ah, okay. And they also mention they are deliberately stocking up heavy for Arcteryx because they've been sold out of key sizes and colors way too often lately.
Which is the definition of a high-class problem to have in retail. Oh no, we have too much inventory, the exact item everyone is lining up to buy, and given that their leverage is pristine, they are sitting at only 0.3 times net debt, the market is definitely inclined to give them a pass on the inventory build for now.
Okay, let's pivot to the future. The outlook. The 2026 guidance. Because this is where the rubber really meets the road for the valuation, and this is probably the other major reason the stock took a dive today.
Yeah, this is where the market got some serious indigestion.
So revenue guidance for FY 2026 is strong. They're calling for 16 to 18% growth. Earnings per share is guided to a range of $1.10 to $1.15. But the margins, adjusted operating margin is guided to 13.1 to 13.3%.
So let's recall, we just finished 2025 at 12.8% after that big drop. They are guiding for essentially flat or at best very minimal margin expansion next year, despite projecting double-digit revenue growth again.
That implies the spending spree at Salomon is not over.
It is absolutely not over. They are doubling down. They're looking investors right in the eye and saying, we're going to keep spending heavily on retail stores, on marketing campaigns, and on high-end designers. They are not pivoting to profit harvest mode yet. They are still firmly in empire build mode.
There was also a weird little accounting note in the guidance, this corporate cost shuffle. Can you explain that? Because reading it, it felt a little bit like a magic trick.
Yeah, this is deep inside baseball, but it really matters for how we read the quarterly segment reports next year. Management is reallocating about $50 million of costs away from the individual brand segments and moving it back to the corporate line item.
What does that actually achieve?
It makes the segment margins, specifically for outdoor performance and Salomon, look way better optically. So next quarter, Salomon might show a sudden margin improvement on paper, and people might cheer. But part of that improvement will simply be because they moved the bill for, say, HR or IT from the Salomon spreadsheet over to the corporate HQ spreadsheet.
Wow. So it flatters the individual brands, but it doesn't change the group's bottom line one bit.
Exactly. It's a purely cosmetic accounting adjustment. Savvy investors see right through that immediately, but it does tidy up the segment reporting to make the individual brands look healthier on a standalone basis.
So we have a situation where the top line growth is undeniable, but the profitability is intentionally being suppressed by massive investment. This brings us back to the core thesis check for anyone watching this ticker. Is Amer Sports a growth stock or a value stock?
That is the ultimate identity crisis for AS right now. The bull case is crystal clear. This is a unique portfolio of super brands. Arcteryx and Salomon are still very early in their global direct-to-consumer expansion.
Right.
If you believe Salomon can actually become the next Hoka or a massive global streetwear staple, buying this 5% dip today is an absolute no-brainer. You are paying a reasonable price for 20+% growth in a macro world where real growth is incredibly scarce.
And the bear case?
The bear case is that they are just buying this growth. They are spending their way to revenue beats.
Yeah.
If Salomon's fashion pivot doesn't stick, if the trends shift and that XT6 sneaker becomes uncool next spring, then you are left holding a company that has permanently high structural costs, really expensive Paris offices, and dozens of fresh store leases.
Yeah.
You're paying a high luxury multiple for what will suddenly revert back to being a low-margin ski equipment manufacturer dressed up in high-margin clothing.
It is a really high-stakes game of brand management.
It really is. It's a massive bet on their internal ability to execute a cultural fashion transformation.
All right, well, that brings us to our absolute favorite segment of the deep dive. We are going to switch hats now. We are taking off our objective earnings reporters' hats.
I've got my Arcteryx fleece zip-up on. I am ready to pitch the investment committee.
It is time for, this is not financial advice. We are putting on our hedge fund pod analyst vests.
Let's do it.
Quick disclaimer time for the listeners. This is not financial advice. We are just two voices on a deep dive. Do not trade your portfolio based on what we say here. We are speculating purely for entertainment and educational purposes only. Okay, expert, what is the trade today?
Okay, I have been workshopping this one since I read the print last night. I am calling this trade the Gorp Core Monopoly, or maybe the Paris Hedge.
The Paris Hedge. I like the sound of that. What's the setup?
The setup is this. We have a company here, Amer, that is taking the massive, reliable cash flows of a $1,000 raincoat brand, Arcteryx, and using them to forcefully buy its way into the Paris fashion sneaker market via Salomon.
Forcefully is definitely the right word. They're brute forcing their way in with a mountain of cash.
Exactly. So here is the trade structure. You go long Amer Sports ticker AS, and you simultaneously short a traditional luxury holdco.
Like who?
Like a Kering, the owner of Gucci and Balenciaga, or maybe a specific pure play sneaker rival that's currently losing heat in the market.
Ooh, spicy. Shorting traditional luxury to buy outdoor gear. What is the core logic there?
The logic is wallet share displacement. Think about the high-end consumer for a second. Arcteryx is growing at 34%, pulling in luxury-level margins. Who are they stealing that specific customer from?
Well, they aren't stealing them from the North Face or Columbia.
No. They are stealing them straight from the traditional luxury houses. They are effectively eating the discretionary budget that wealthy consumers used to spend on designer handbags or traditional luxury wool coats. The ultimate status symbol in certain circles has fundamentally shifted from a logo-covered bag to a highly technical minimalist shell jacket.
That makes a lot of sense, actually. It's a vibe shift. It's saying, I'm not rich and flashy. I'm rich and adventurous.
Precisely. And then look at Salomon's moves. They are explicitly setting up a Paris hub. They hired former diesel designers. They aren't competing with Merrell hiking boots anymore. They're competing with Balenciaga's oversized sneakers. They're taking direct aim at the high-end fashion sneaker market.
So the overarching thesis here is the broader market looks at this report, sees a margin miss, and blindly sells the stock down 5%. But the pod analyst looks at it and sees a fashion house transformation playing out in real time.
Exactly. You buy the dip today because Wall Street algorithms think Amer is just a ski company having a bad expense quarter. But you, the smart analyst, see that it's actually morphing into a luxury streetwear conglomerate. If they manage to pull off this transition, the multiple expansion on the stock will be massive. You're essentially buying a future luxury house at a sporting goods valuation.
That is a very compelling pitch. Super risky, obviously. If the fashion trend dies, you are in deep trouble on the long side. But if Gorpcore, that whole trend of wearing technical outdoor gear in urban environments, if that is a prominent secular shift, this trade absolutely prints money.
And looking at that 40% growth, specifically in women's apparel for Arcteryx, I think the trend has real legs. Women's fashion is usually the leading indicator for broader retail trends. If they are winning that heavily there, the guys will follow and the trend will stick.
Well, there you have it, the Paris hedge. Again, absolutely not financial advice, just a wild theory to amuse your trading friends with at happy hour.
But a fun one to track.
Definitely. So let's wrap this up and recap the key points for the listener who's just finishing their commute.
Simple takeaways today. 1. Amer Sports completely crushed the top line. $2.1 billion in sales. The demand is absolutely real. People want the product regardless of the macro environment.
Yep.
2. Salomon is spinning like crazy right now to become a global sneaker giant. This hurt short-term profits significantly and tanked the stock 5% today.
3. Arcteryx is basically unstoppable. It is the high-margin cash cow that is funding everything else in the portfolio.
And 4. The stock dropped today because investors wanted those profits right now. But Amer management is clearly playing the long, expensive game.
Yeah. Ultimately, the key to 2026 for this stock isn't what happens on the ski slopes. It's whether that new XT Whisper sneaker takes off on the streets of Soho and Shanghai.
Just keep your eyes firmly on that SG&A expense line in the coming quarters. If they don't start getting leverage on that massive spending by Q4 of 26, the entire narrative breaks down. But for now, they are swinging for the fences.
And we will be watching every single pitch. Thanks for joining us on this deep dive.
See y'all next time.
Keep your eyes on the ticker.